Hello everyone and welcome to this week's FX update. My name's Craig Erlam, Senior Market Analyst at OANDA. Thank you as ever for joining us today. I hope you've all had a lovely couple of weeks since the last webinar which I did. I know, of course, my colleague over in New York, Ed Moyer, did a session last week as well. So I hope you all enjoyed that. This week, again, the session will go as usual. We'll cover some of the fundamental topics, look ahead to the key events this week, which, as you can probably see by my latest article on there, really does focus around Fed Chair Jerome Powell. And then we'll take a look at some charts, give my analysis of the charts. And as always, these sessions are intended to be as interactive as possible. So if you've got any questions or if you'd like me to take a look at anything in particular, if you've got any views on what I'm saying, please do share, and we'll hopefully make as much of this as we possibly can. So we'll crack on with the economic calendar, and we'll touch on some of the other fundamental stories which are having an impact on the markets at the moment, and we'll also touch on them as well as we do go through the charts once we see what's moving and give some background to those moves also. For those of you who are joining for the first time, this is the OANDA Market Pulse website. This is where myself and my colleagues post content on a 24-hour basis. My colleagues over in Toronto, in Singapore, etc., all updating the website 24/5. So there should be something for all of you. It's also where you'll find the economic calendar, which is what we will come to next. Now, I'm being told that there may be some audio issues, so if you could let me know if the audio is working for you, that would be great. It looks to be working from my side, so if there is any issues, the audio is working. Perfect. Thank you very much. We can crack on then. I will just inform the person who messaged that it must be their side. Okay, so yeah, this is the economic calendar. Again, for those of you who who haven't attended this before, the economic calendar actually can be found on the Market Pulse website just up here, and it basically lays out all the economic events which we know are coming this week, and it also gives them an order of priority as well. So in terms of volatility, you've got low volatility, which is one exclamation mark, and it's in yellow. I tend to take those out for the sake of this webinar because they tend to be low impact events. That's why they're only one mark. Then you've got medium volatility and high volatility. So they're the ones which we'll focus on today. As you can see, slow start to the week, really, and one which really does center around the US. Actually, this week is very much one of those weeks in many ways, barring a couple of other events along the way. We've had a little bit of data out so far at the start of this week. Really, the major stories this week have actually centered around at the start of the week have centered around other things which wouldn't appear on the economic calendar. So I'm talking Deutsche Bank announcing, for example, that it's going to be making 18,000 people redundant. That was a major market story yesterday. That's what all the networks were really focusing on, and this is mainly a Deutsche story. So the global knock-on effects are not visible. This is not like another Lehman situation. This is very much just a story which is centered around Deutsche Bank in particular. There was the Turkish central bank governor being sacked. Now, I think that was a big story, and we will, if we've got time, to touch on the Turkish lira and the impact that we're seeing there, because it seems that President Erdogan is very unsatisfied with the lack of a response. Now, this obviously sounds familiar. A lack of a response from the central bank in cutting interest rates to support the economy. Now, obviously, there's one major difference with the US and Turkey here. Turkey is running with a huge level of inflation. Interest rates were hiked up above 20% for the simple reason of stemming inflation, which is seen as a far greater risk than a temporary period of higher interest rates. Erdogan views this differently. He's voiced these opinions before and actually suggested that lower levels of interest rates actually cause lower levels of inflation. Now, that goes completely against what is widely regarded as the amongst economists in terms of the relationship. Now, it seems that he's taken action into his own hands by sacking the governor, and we'll see how that does pan out. This really does grey the area between the central bank and the government. The independence of the central bank has long been seen as an important aspect because it severs the ties with politics, because it focuses the decision making on price stability as opposed to short-term political gains, which you could argue is what President Erdogan is now focused on, having lost the Istanbul election. I think the timing of this is not a coincidence. From a currency perspective, we did see the Lira weaken yesterday, and we'll come back to that in the charts. But this could have serious knock-on effects in the longer term, depending on what happens next. If the president is seen as taking control of monetary policy in any stance, in any way, shape, or form, we could see significant and severe consequences for the Turkish lira. And maybe this is a lesson for Trump, who has obviously been very vocal in his criticism of the Fed and the slowness in cutting interest rates, the latter part of the rate tightening cycle as well. There has been reports, obviously, that he looked to oust as well Jerome Powell, but that never actually materialized. Maybe there is lessons to be learned here also. It does seem that this is becoming a little bit of a theme of the last few years. Politicians weighing in heavily on the activities of the central bank. We've obviously seen it here in the UK. Particularly around Brexit. We're starting to see it occasionally in Europe as well, particularly in Italy. Maybe this has become the new temporary norm, this coinciding with this wave of populism which we've seen everywhere. But it is dangerous, and I think, again, we will see the knock-on effects of that in Turkey over the coming months. In terms of the economic events which we've got this week, like I say, it really focuses around the Fed. Now, again, the Fed very much at the front and center. We've got Jerome Powell speaking today. Now, this is just given in the opening remarks at a conference, so I don't think we'll get too much from this. It's his speeches over the next 2 days, which I think people are going to be far more focused on. This is his speeches, his testimonies, sorry. Firstly, in front of the House Financial Services Committee. That's tomorrow, 2 p.m. UK time, 9 a.m. If you are in New York. And then on Thursday, in front of the Senate Banking Committee, again, the semi-annual monetary policy report. So these two events do tend to be quite similar, can become highly politicized. There's not always too much to take away from them, if I'm perfectly honest. However, at this point in time, when the markets and the central bank seem to very much not be on the same page, it will really be interesting to see what happens. Markets are currently pricing in a 100% chance of a rate cut at the meeting at the end of this month. Now, that is hugely significant. Previously, there was actually, a couple of weeks ago, it was actually priced in 40% chance of a 50 basis point cut. So that'd be quite drastic when you consider that Trump keeps telling us that the economy is the best it's ever been, that the markets are at the record highs, that the labor market is the best it's ever been. So factoring in a rate cut so severely seems quite drastic. Now, that's been very much tempered back to less than 4%. I think that really does align with Bullard, who's one of the more dovish members of the Fed, indicating that he would favor 25 basis points over 50. But I think the strong favor here is just for one 25 basis point cut. Now, what's interesting is we go to December, where we were floating between 2 and 3, and we're still very much there. We're currently at around 58% in favor of 2 rate cuts and 42 on 3 rate cuts. Now, that's current market pricing, but it's also market pricing that doesn't seem to really fall in line with what the Fed have previously indicated. The Fed has left the door open to rate cuts, but very much has been non-committal on them. I think this would take, we need to see the language changing from the Fed very soon if this is going to become reality, especially if we're going to see another rate cut in September. So that's what people will be really looking for in these testimonies on Wednesday and Thursday, I feel, from Jerome Powell. Now, what's interesting is the markets have been coming off the last couple of days. That follows the jobs report on Friday. We saw a strong, another decent jobs report. Unemployment did tick higher, but jobs creation was much stronger than was forecast and was even above the upper bounds. And this actually triggered a sell-off in the markets. Now, that may be counterintuitive, but we have seen it a little bit recently. We became very accustomed to it about 5 years ago, when we were going through this good news is bad news is good news phase. The idea being that we were basically leaning heavily on the central bank, and therefore the idea that if the data was bad, that would inspire more stimulus, which could continue to support the markets. If the data is temporarily good, then that could discourage further stimulus, which would be negative for the markets because the economy itself wasn't seen as being strong enough to sustain. Now, obviously, that is not a good period to be in when you're fully reliant on the central bank to support the markets. But that does feel like where we are right now. And the markets have been quite negative, really, since those Friday numbers. So what that means is if the Fed doesn't signal, if the Fed does signal that there could be 2 or 3 rate cuts this year supporting the market view, then that could potentially undo some of the damage since the jobs report, could help to lift sentiment again, because there's such a strong signal that the market is on the right course, could even force the market or push the market into becoming even more aggressive on their rate cut expectations. What would be interesting, though, is if the Fed doesn't allude to this, if the Fed maintains the message that the door is open but nothing is guaranteed, non-committal, or even sends a message that 3 rate cuts is too much and the market is offside in many ways. This is something where the market just in the past has tended to call the Fed's bluff. Now, that doesn't mean, and it really does depend where you're looking. That, for example, in the stock market, that may cause a bit of a shudder, that may cause a bit of a shock. But when the Fed has not been in line with the markets before, or when the Fed has been slow to respond in these situations before, market pricing seems to stay very seems to be very resilient, very stubborn in many ways. So on the one hand, while the Fed coming over to the market way of thinking could be positive for the markets and could force more aggressive pricing, if the Fed doesn't agree, then, and if Powell doesn't suggest otherwise, we may actually see the pricing remain just as it is. We may not see much of a change because the markets do seem to like to call the Fed's bluff in these situations. So these are the key the key things I think many people are watching this week. Of course, there are other events, as you can see here. Another one that stands up. It's worth also pointing out we're going to hear from a lot of different policymakers over the course of this week. You can see here Bostich, Callers, Bullard, all speaking today as well. We'll hear from Bullard again tomorrow, and also Williams, Bostich again, Kashkari, etc., throughout the week. And I don't even think this covers all of them, if I'm perfectly honest. We'll also hear from policymakers as well, from, as you can see, the Bank of England, I think a couple of ECB speakers as well. So certainly want to keep an eye on at a time when central banks are becoming much more accommodative again, it seems, or at least heading for a much more accommodative stance. We will also hear from a central bank. Bank of Canada will announce its latest monetary policy decision. They're expected to keep interest rates at 1.75%. Again, it'll be interesting to see where they stand. They have seemed to track the Fed in many ways. They were tightening interest rates. They have, since their language has become more accommodative more recently. So it'll be interesting to see what they signal for the rest of this year as well. We've got the Fed minutes, of course, which I forgot to mention on Wednesday evening. Also, that's from the June meeting. Again, looking for further signals. The issue that I always have with these kinds of minutes is we get so much information from the quarterly meetings that you wonder how much more the minutes can actually contain, because we've got to remember, we don't just have the actual announcement itself and the statement. We also have a press conference with Jerome Powell. We get the dot plot, which shows intentions for interest rates going forward. We get the we have the minute, not the minutes. We have a whole host of different releases around that actual decision itself, clearly indicating what the Fed's intentions are, and therefore you wonder how much more detail the minutes can possibly contain. Heading on, we've also got inflation data on Thursday. Now, what makes this inflation data important and notable, and maybe can make it underestimated at times, is the fact that while it's not the Fed's preferred measure of inflation, which is the core PCE price index, it does tend to be released around 2 weeks earlier. So it's the first indication we get of inflation for June. The numbers tend to be a little higher than the core PCE as well, and that's going to be really notable this month as well, especially if we do get any kind of numbers in line with expectations, because as you can see, while core is expected to remain at 2%, overall inflation is expected to drop quite considerably to 1.5%. That's the type of move we can expect to see mirrored in the PCE. That will pile a lot more pressure on the Fed. So this number could be really interesting given the week that we've got centering around the Fed as well. And then we've got obviously import and export data, trade data from China in the early hours of Friday morning, which again, given the situation we have with the trade war at the minute, and obviously given what came from that G20 meeting, will always be very interesting. Now, I think I've waffled on for more than long enough. I'm sure you're ready for a look at some charts rather than just a chat about the fundamentals. And with that, I will bring up the euro dollar chart. The euro, we have obviously seen this pullback a lot now over the past week or two, following that jobs report. Sorry, just being a little bit distracted there. We have seen this pullback quite a bit now. We first saw it pull back initially, actually, just a couple of weeks ago, but really we saw this. I think was a bit of a correction from the rally that we saw previously. It was this move here which followed the jobs report, which has seriously pulled this back into more interesting territory now. And what makes this more interesting is we'd had this breakout from the declining the declining channel here. We ran into some resistance around the moving average band. We did peak above it, but then we started to consolidate around it. Now, if we'd have just seen this correction into the 38.250 fib zone and we'd have rotated higher, then that could have been a nice little bullish signal. But then obviously we saw the jobs report on Friday that sparked some dollar strength because of the hawkish signal that it potentially, or the less dovish signal that it potentially sends. And we've seen the dollar basically rallying ever since. This brings us back into a different kind of territory for me, because we've gone through the 61.8 fibs. Now in the 61.8, 78.6 zone. This is deep correction territory, which is always a little bit more worrying. The flip side of that is we are in a long-term downtrend, so seeing these deeper corrections don't put me off entirely. But if we see a breakthrough to 78.6, which is just below the recent low as well, then that may suggest that there's been a change. These changes aren't always foreseeable. These changes aren't always obvious. I think the fact that we saw a break high previously suggested that the market was becoming more bearish to the dollar and was starting to become more bullish on this particular pair. But the situation can change, and if we do break below those levels, then that may suggest that that's exactly what's happened. We have to remember that technical analysis and charting is taking all the information that there is at that point, and you can monitoring the behavior of traders to the information that you currently have at hand. Of course, if that information changes, then the chart changes with it. So I think that 78.6 level, this kind of area around 111.75 through the 112, is going to be really, really interesting. Now, if we break through there, then that would suggest we're seeing that this temporary blip higher has been unwound by the stronger data, potentially by some less dovish rhetoric as well from the Feds, which again makes this week all the more interesting. Cable is breaking lower today. We've been on a negative run really for cable for the past couple of weeks, and we've actually broken to new lows. And again, this was one that was potentially looking like it could break higher. But again, dollar developments really have driven a change here. It looks though we could have potentially been seeing a little inverse head and shoulders here, and we did hold up around the 125.50s, which was in line with the lows that we were seeing here. Again, further potentially signaling that we were seeing just this corrective move forming. But now that we've broken below, and we've broken below primarily on dollar strength, we're seeing some sterling weakness today as well. There seems to be a number of stories which are surfacing again with relation to sterling. It's always hard to see which ones are proving hugely significant. For example, we've had Dominic Reeves submit an amendment to Parliament today, an attempt to try and prevent Boris Johnson effectively suspending Parliament temporarily later on this year in order to get no deal through and stop Parliament blocking no deal. That was rejected, interestingly, today from John Bercow, the Speaker. That's what's been reported anyway, just prior to coming onto the webinar, which is interesting because everything he was doing pre-March 31st seemed to be in favour of the Remain side, seemed to be in favour of preventing no deal. So it will be interesting to see why it is exactly that this has been rejected, given that the intention is to stop stop the parliamentary democracy being subverted. There's other stories as well which could have been seen as positive. So, for example, Jeremy Corbyn suggesting that challenging the new opposition leader, whoever he may be, to put any Brexit deal to a referendum, suggesting that Labour would back Remain against a no-deal Brexit or a conservative Brexit. Again, I think that's a lot of playing party politics, to be quite honest with you. We know that the Labour Party would not back a Tory Brexit or a no-deal Brexit, but it also allows them to take some of the media pressure off themselves, because they've been heavily pressured in the media recently to pick a side, to make clear to the public what it is they back. Now, they're kind of caught between a rock and a hard place, because the party primarily favours remaining in the EU and campaigning to do so, campaigning for a second referendum. However, there are members in the party who did back leave, but there's also a large portion of voters, Labour voters, who voted to leave as well. So it's about finding that balancing act between backing what the party faithful wants while not losing votes in the meantime. And it's that kind of indecisiveness and that lack of clarity which has really put Labour forward for a lot of criticism. And it seems that this is their latest way around trying not to offend anyone effectively, which is suggesting they will remain against the Tory Brexit rather than against Brexit at all, thereby alleviating themselves of any blame or any accusations of not of going against the will of the people as it's being sold. Now, whatever the report is today that's sent sterling low, it could be the Grievement, but it was already heading lower anyway. We are now testing these lows, and in fact, in the last half hour or so, we have actually broken through these kind of 124.50 lows. We haven't held below here yet, but it is going to be interesting to see how that materializes. Now, as you can see, I've left this on here on the momentum indicators, because what is interesting is we made a new low here before reversing high. This was one of the reasons why things were potentially looking a little bit more bullish, was that we made this latest low on much lower momentum. And while we were coming back towards these lows again, momentum was very much not supportive of the move. What is interesting again, though, is that while the MACD histogram has started to make a new low compared to this one, the moving averages and the stochastic are really lacking, really lagging behind. That suggests to me that there's not enormous amounts of confidence. Now, if we do break below these lows and these stops are taken out below here, then that could seriously pick up and that could really change things. So certainly one to watch, because this rally does seem to have some legs, with just the momentum indicators aren't necessarily entirely backing that up yet. But of course, this is a very big support level in the near term. In terms of where below here, looks like interesting support. For me, you're kind of looking around these kind of 123.75s, 123.50s potentially. I'm looking back here for those of you who obviously can't see my eyes on the screen. But I think this is a very notable break should we see that unfold. Euro sterling as well, we're seeing a similar thing. We've started to see this top out a little bit and failing to really capture these highs, failing to build on these new highs. Every time we've made one, it seems to have retraced back, and that's been very much highlighted in the momentum indicators as well. The momentum indicators as well really struggling to confirm even the latest rally, which casts a lot of doubt. We've highlighted this region between these kind of 89.50s and 91s before, have been previously been strong resistance. So again, the fact that we're seeing momentum lack here is not entirely surprising at this stage. It doesn't necessarily fill me with much bullish confidence at the moment, but the weaker sterling, which we are seeing today in particular, is aiding that move in the near term. The Aussie, we've seen it pull back from that interesting level, unfortunately, and again, the US dollar is very much heavily playing into that, so there's not really too much to add from that perspective. I'll keep an eye on these fib levels once again, in very much the same way that we will with the euro dollar pair. Probably the 61.8 fib and the 78.6 probably stands out for me, even around like these kind of lows around the 68 60s, having been a low before. But we are potentially facing a deeper correction here because of the way that we are seeing the dollar moving right now, and because the longer term trend is negative. Dollar CAD, the trend is very clear. On the other hand, we did pull back through the rising channel here, and we saw a bit of a corrective move to the 50 fib, and since then it's been all downhill. We've broken through the moving averages. We've found some support around these kind of lows. If we see a bit of a corrective move back up to here, back up towards the 132.50s, 133s, that doesn't worry me in the slightest. We've already seen a sharp sell-off, and for me, this continues to look bearish with a bit of a with potential for correction in the pair. Not, like I say, not particularly concerning. And let's face it, the moves that we've seen in the dollar in this pair have been far less significant compared to what we've seen in other pairs. Sterling CAD as well is very much another one here. The Canadian dollar potentially benefiting from the rally that we've seen in oil, as we've said previously. This has very much picked up momentum to the downside rather than lost it, as we've seen in the in other currency pairs. We're finding some support here around the kind of 63.50s, 64s, which again, as you can see past here, back here. Again, we're looking at a bit of a broader range here, but really it's around the kind of 162.50s through these kind of 163.50s, where we've previously run into plenty of support. So that's the kind of area that I'm keeping an eye on right now. We're into that level now. Again, I'll be keeping an eye on the momentum indicators, but we don't seem to be lacking too much as far as the stochastic moving averages and the stochastic and the MACD moving averages are concerned. Potentially some warning signs in the histogram, but even that started to pick up recently. Clearly a very strong trend building here, but again, these levels 62.50 to 63.50 could be potentially key. Kiwi dollar, US dollar, we've rebounded off that 50, the moving average band, which we've highlighted previously. Again, the US dollar strength really does play a lot into that. We've kind of got this imperfect double top here around the 67.20 through 66.60. I've said before, textbooks would suggest that gives us a possible price projection, in this case around 60 pips, which could take us back towards the kind of 66s. That's already materialized. We've had a nice little projection lower there, where we've now run into some profit taking. We saw a little bit of a rebound into that previous the word escapes me. Who knows? Maybe it'll come back to me. The previous low, anyway. We've rebounded off that, and we're testing the lows once again. In terms of where stance is on this, it looks like we're building up momentum to the downside quite clearly in the stochastic here, potentially in the MACD as well. The US dollar doesn't seem to be letting up at this moment in time. So while longer term, that doesn't necessarily mean we're heading back towards these 64.80s. If we do see more downside pressure, then that wouldn't necessarily come as too much of a shock. Got this longer term support area here, which could be of interest around these levels. It also falls around the 50% retracement of the move from these lows to these highs, so potentially an interesting area to be keeping a close eye on. I said I'd take a quick look at the dollar Lira chart, so that's what I'll do. What was interesting about yesterday's move, which is the main reason why I wanted to bring this chart up, is that the rally wasn't as significant as I feel like it should have been. Now, whether this is because the deputy governor was effectively given the role for now, and maybe people think that will not indicate a dramatic change in the central bank's monetary policy outlook in the near term, maybe suggesting that it's more of a case of a fallout between the president and the governor himself, or if it's a case of we'll just wait and see what actually happens next and whether we get more evidence that we're seeing more interference from a political standpoint. I'm not too sure. It was around a couple of % move, so not entirely insignificant, but I just don't think it was necessarily as significant as it could have been. The fact that we're only seeing this pair those gains today, those suggest that there may be further pain to come potentially for the Turkish lira. So it's certainly one to watch, I think, right now, because if we do start seeing interest rate cuts in the next couple of months, then there is potential, I think, for this to get quite messy. Wrap things up quickly with the yen chart. We did see a break lower in dollar yen. We found support here around the kind of 107s before correcting higher. Again, the latest dollar move has obviously aided this up again. We've kind of got this potential inverse head and shoulders formed here. It's not perfect, which always does worry me, but Potentially, you could even call it a slanted head and shoulders. Let me just get that on. And that has already broken high, so potentially a bullish signal here. The key level for me still remains these 110s, because this is where we're interacting both with the Ichimoku cloud, prior levels of support and resistance, and a breakthrough here could potentially be a bullish signal for this pair. Again, I'm just not particularly confident in this dollar rally to be sustained in the overly long term. However, if Powell is hawkish tomorrow, then who knows? Again, massive week, I think, from a US dollar and equity markets perspective. Sterling yen has been much more one way. What's interesting, though, for me, again, is the fact the momentum is really sending some signals here, some red flags galore. We've obviously seen some sterling weakness today, but we're not really seeing momentum build on the back of this. This looks to be a bit of a bottoming pattern coming around that support, which we've highlighted previously, which we're really struggling to hold below. And finally, euro yen. Again, this looks like a bit of a messy chart, so I will just remove a couple of bits actually, just to get to get rid. We rallied between 38.2 and 50 fibs before, which coincides with that moving average band and interfering almost with that Ichimoku cloud. We've rebounded off there, but we failed to make new lows, which always worries me about the strength of a trend. The only thing that comforts me is the fact that the price action in the last few days has been one more of consolidation rather than a rebound. So if we can continue to see more price action to the downside, take that 121.35 out, then how we approach these kind of 121s will then become key, because we have to remember the prior time to that, when we tried to take out the low, we fell just short before rallying back to the 50 fib. So again, not a perfectly bearish setup here, and one that makes these most recent low all the more important. Now, apologies to rush that little bit of ending, but we have already run over. I hope you found that useful. If you've got any questions and you didn't fancy asking them today, please do reach out to me on Twitter. My Twitter username is Craig_Forex. You can also find plenty more content on MarketPulse.com. You can check both of those platforms out to find a recording of this webinar later today, and you'll also find it on YouTube as well. Please do check out all the rest of the content we push out, the Market Insights podcast, which will be released later this week as well. Please do subscribe on iTunes or wherever you get your podcasts. Last week, Alfonso Esparza in Toronto filled in on my behalf. I've listened to it back. It was a fantastic podcast again. So please do check that out. Leave your reviews, leave your feedback. Everything is welcome. And apart from that, more importantly, have a fantastic week. And I wish you all the very best of luck with your trading. Thank you.